Price keeps testing the floor, but every bounce still has to fight old memory. The week forms between weekly 0.33 and weekly 0.25. That is the pressure field. Not one candle. Not one signal. Not one clean direction. This week, the 1-hour chart gave fast trades. Some longs worked. Some shorts worked harder. Some sessions moved but gave no clean trade. That matters. The market did not reward prediction. It rewarded location. It rewarded the line. It rewarded the trader who waited for price to reach, react, fail, and return. Before the 1-hour chart, the higher time frame must stay visible. Monthly, weekly, daily, especially weekly. The weekly chart is not background. It decides where the 1-hour move can survive. It decides where a bounce can stall. It decides where a short can still pay after price already looks low. This week, the major field stayed clear. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those areas kept controlling the 1-hour chart. Price moved fast, but it kept returning to memory. A session would hold. Then a trade would open. A session would fail. Then the opposite side would open. A session would overlap too tightly. Then no trade protected the account. That is the rhythm of the week. We start with the 1-hour chart because that is where execution happens. Entry, stop, target, trail, no trade. But we cannot stop there. The 1-hour chart shows the fight. The daily chart shows the path. The weekly chart shows the field. The monthly chart shows the larger risk. Without the daily chart, the 1-hour drop looks random. Without the weekly chart, weekly 0.33 looks like only a line. Without the monthly chart, the February low looks too small. But when all three timeframes line up, the week becomes clearer. Price did not fall by accident. It moved into the same lower memory that had been waiting since February. It tested the February 5th key low. It bounced. It reclaimed weekly 0.33. Then it failed again. That is why the daily sessions were painful. The bounce looked strong, but it did not get freedom. The drop looked dangerous, but it did not always give a short. The final session moved, but it did not pay enough. So the method had to stay strict. Stop line first, entry line second, target line third. If the risk-reward does not reach the filter, the account waits. This week gave a full execution lesson. A long can start from lower memory. A target can become the next short area. A weekly line can hold first, then fail later. A session can move but still give no trade. The trader who wants action suffers. The trader who waits for the line survives. Now we go through the higher time frame structure. Daily first, then weekly, then monthly. Do not use this as a recap. Use it as the map for next week. If price holds weekly 0.33, the next 1-hour long can form later. If price fails weekly 0.33 again, the short can return. If price rotates between 0.33 and 0.25, the best trade may be smaller. Or no trade. The chart will move. The account should not move until the line pays. Price pushes higher, but the move still begins inside old pressure. The session forms inside compressed weekly memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. If price moves near those areas, a 1-hour candle can look strong and still lose control. A breakout can look late and still continue. A pullback can look dangerous and still protect the trade. That is why we do not trade the candle alone. We trade the session line. Now look at June 14th Asia session. June 14th Asia session forms above the weekly 0.33 area. It forms at the midpoint of the June 3rd Asia session box. It compresses by about 50%. It overlaps there. That matters. A compressed session box gives a tighter decision. The distance becomes shorter. Reaction can come sooner. Continuation can fail earlier. But compression also gives a cleaner line. Price has less room to hide. When the line breaks and holds, the move can accelerate. June 14th Asia session forms inside that pressure. Then price tests June 14th Asia session upper boundary. It also tests June 2nd U.S. session lower boundary. That first test is important. Price reaches the upper side. It does not collapse. It starts to build pressure upward. Then price rises again. It breaks above June 2nd U.S. session upper boundary. Then price reaches toward June 3rd U.S. session lower boundary. The movement follows a clear path. Compression. Upper boundary test. Break above older U.S. memory. Return toward the next higher U.S. lower boundary. That is the visible structure. Now we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price rising. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the trade does not deserve execution. So the long starts with risk. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination that gives more than 1.5 risk-reward. If no clean combination appears, the trade is skipped. For June 14th Asia session, the long setup is clear. Long entry line. June 14th Asia session upper boundary. Stop loss line. June 14th Asia session lower boundary. Take profit line. June 3rd U.S. session lower boundary. Risk-reward ratio 1.83. The entry sits at June 14th Asia session upper boundary. Why there? Because the session forms compressed. The upper boundary is the line where buyers must prove control. If price stays under that upper boundary, the long is not ready. If price reaches it, breaks through and holds, the compression starts to release upward. The entry is not the first green candle. The entry is the hold above the active Asia upper boundary. Price reaches the upper side. It reacts. It does not return deeply. Distance begins to open upward. Then the long becomes active. The stop sits at June 14th Asia session lower boundary. Why there? Because the trade depends on the compressed Asia box holding. If price loses the lower boundary, the breakout has failed. The session no longer supports the long. The move has returned through the whole box. The trade idea is damaged. So the lower boundary becomes the failure line, not a random loss limit, not a fear line. The line where the trade loses its reason. If price reaches it, leave. No hope. No argument. No waiting for one more candle. The target sits at June 3rd U.S. session lower boundary. Why there? Because price is moving from the compressed June 14th Asia box toward older, higher U.S. memory. June 3rd U.S. lower boundary is the next meaningful line above the breakout path. It is where reaction can appear. It is where buyers must prove they can continue. So the target is realistic. It is not unlimited upside. It is the next working memory. Risk-reward ratio is 1.83. That is above the 1.5 filter. But it still needs clean execution. If entry is late after price already leaves the upper boundary, the ratio weakens. If the stop is widened below June 14th Asia lower boundary, the ratio weakens. If the target is moved higher before price earns distance, the trade becomes hope. This is not a chase. It is a controlled breakout from compressed session memory. Now watch the behavior. Price moves above the June 14th Asia upper boundary. It pushes toward June 2nd U.S. upper memory. It breaks higher. Then it reaches toward June 3rd U.S. lower boundary. But the movement still needs management. A long can pay and still fail later. A breakout can move and still return sharply. The trader must protect when distance is earned. If price reaches the target and stalls, protect. If price keeps distance and reaction stays shallow, a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear, not greed, not the last green candle. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays faster. But compressed boxes can whip. A wick can touch the tight stop. Then price can still move toward the target. The idea was right. The position is gone. That pain must be accepted. A conservative trader gives the structure more room. The stop respects the lower boundary. Position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the conservative answer. Here, the setup gives 1.83. So the long can be executed. But only if entry stays near the line. Partial profit can help. If price reaches the target and reaction speeds up, a conservative trader protects more first. 60% first. 40% left for continuation. If price holds and distance keeps growing, an aggressive trader can leave more open. 40% first. 60% for continuation. If the move reaches multiple stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from the line. The edge comes from compression holding. The edge comes from a target that pays. June 14th Asia gives the first message. The session forms above weekly 0.33. It compresses at the June 3rd Asia midpoint. Price reaches the upper boundary. It holds. It breaks higher. The long earns execution only after the line survives. Price reaches higher memory, but the upper side still refuses easy continuation. The session forms at the lower side of old U.S. memory. Before reading June 15th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st, weekly basis box lower boundary. March 1st, weekly basis box lower boundary. February 1st, weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. the falling trend line, the rising trend line. Those levels still shape the 1-hour chart. The market has already pushed up from compressed Asia memory. But a push does not erase the field. A recovery can reach old resistance. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 15th U.S. session. June 15th U.S. session forms at the June 3rd U.S. session lower boundary. It overlaps there. That matters. The market is no longer moving through empty space. It is pressing into old U.S. memory. When a new U.S. session forms at an older U.S. lower boundary, that line becomes a decision point. Price can hold it and continue upward. Or price can fail there and rotate down. The session gives the trade, not the candle. After June 15th U.S. session forms, price moves higher. It tests June 3rd U.S. session upper boundary. Then price falls. It tests June 15th U.S. session lower boundary. The movement creates two separate structures. First, a long from the lower side toward the upper side. Then, a short from the old upper side back toward the session lower boundary. But both trades must pass the same filter. Stop line first. Entry line second. Target line third. Risk-reward above 1.5. If the combination is not clean, skip. Now build the first trade. June 15th U.S. long setup. Entry line. June 15th U.S. session lower boundary. Stop loss line. April 2nd U.S. session lower boundary. Take profit line. June 3rd U.S. session upper boundary. Risk-reward ratio 1.61. The entry sits at June 15th U.S. session lower boundary. Why there? Because price forms at the June 3rd U.S. lower memory and then rotates inside that new U.S. field. The lower boundary is where buyers must defend the session. If price reaches June 15th U.S. lower boundary and breaks down, the long has no base. If price reaches that lower boundary and holds, the move can return toward June 3rd U.S. upper boundary. The entry is not the middle bounce. The entry is the hold at the active lower side. Price reaches. It reacts. It does not break lower. Distance starts to open upward. Then the long becomes active. The stop sits at April 2nd U.S. session lower boundary. That stop is deeper. It protects the larger memory beneath the trade. If price loses April 2nd U.S. lower boundary, the recovery has fallen too deeply. The long no longer has the same structure. The trade loses its base. So the stop sits at the line where the idea breaks. A tighter stop may make the ratio look better. But if the stop is too tight inside a noisy overlap, normal reaction can remove the position. Then price can still move to target. A wider stop can protect the trade, but the size must be smaller. And the target must still pay. Here, the target is June 3rd U.S. session upper boundary. That is the opposite side of the older U.S. memory. Price already formed at June 3rd U.S. lower boundary. If the lower side holds, the upper boundary becomes the clean objective. Risk-reward ratio is 1.61. It is tradable, but not generous. The entry must be clean. If entry is late, the ratio breaks. If stop is widened, the ratio weakens. If target is moved higher too early, the trade becomes hope. This long is a boundary trade. Lower side holds. Upper side becomes target. Now price reaches higher. It tests June 3rd U.S. session upper boundary. That is where the next decision appears. The target can become the next short area, but only after failure. Do not short just because price reaches resistance. Wait for the hold failure. If price reaches the upper boundary and keeps holding above it, no short. If price reaches it, stalls and cannot stay, the short can form. Now build the second trade. June 15th U.S. short setup. Entry line. June 3rd U.S. session upper boundary. Stop loss line. June 15th U.S. session upper boundary 200% area. Take profit line. June 15th U.S. session lower boundary. Risk-reward ratio 3.43. The entry sits at June 3rd U.S. session upper boundary. Why there? Because that is where the long target meets old upper memory. Price reaches that area. If it cannot stay above it, buyers fail. Continuation fails earlier. Distance stops opening upward. Reaction starts to come back faster. Then the short becomes active. This is the same principle again. The target can become the next entry, but only after failure. The stop sits at June 15th U.S. session upper boundary 200% area. That stop protects the short from a real upper breakout. If price pushes through the upper memory and reaches that extension area, the short idea is no longer clean. The market has escaped the expected rejection zone. The failure did not happen. So the stop belongs at that upper extension. It gives room for normal test and wick. But it also defines where the short loses control. The target sits at June 15th U.S. session lower boundary. Why there? Because the short is a rotation back through the active U.S. session box. If the upper side fails, the lower side becomes the first clean destination. The market does not need to crash. It only needs to return through the working session. That return gives risk-reward ratio 3.43. Now the quality changes. The long had 1.61. The short has 3.43. Both can work. But the short has much more distance compared with risk. That does not make it guaranteed. It makes it better structured. The trader still needs failure. The trader still needs entry near the line. The trader still needs the stop. Now compare behavior. The long needs the lower boundary to hold. The short needs the upper boundary to fail. The market moves from lower to upper, then upper to lower. This is session-to-session rotation. Not prediction, not opinion, not bullish or bearish identity. The trader does not marry the long. The trader does not marry the short. The line decides. Price reaches. It reacts. It holds or fails. Then the trade begins. Now management. If the short moves toward June 15th U.S. lower boundary, protect. Do not assume the breakdown continues. That lower boundary can react. If price reaches it and stalls, take the result. If price breaks it and holds below it, a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. The stop must follow structure. Not the last red candle. Not the feeling that sellers are in control. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now the final read. June 15th U.S. session forms at June 3rd U.S. lower boundary. Price tests June 3rd U.S. upper boundary. Then it returns to test June 15th U.S. lower boundary. Long setup. Entry. June 15th U.S. lower boundary. Stop. April 2nd U.S. lower boundary. Target. June 3rd U.S. upper boundary. Risk-reward ratio 1.61. Short setup. Entry. June 3rd U.S. upper boundary. Stop. June 15th U.S. upper boundary 200% area. Target. June 15th U.S. lower boundary. Risk-reward ratio 3.43. June 15th, US gives the second message. The box gives both sides. Lower hold creates the long. Upper failure creates the short. The best trade is not the loudest candle. The best trade is where risk deserves reward. Price falls into old memory, but it does not break through. The session forms at the boundary of compressed support. Before any 1-hour trade, the higher time frame comes first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st, weekly basis box lower boundary. March 1st, weekly basis box lower boundary. February 1st, weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th, key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour candle can look weak and still hold. A drop can look dangerous and still become a long. A bounce can look strong and still fail at the next boundary. So we do not trade the candle alone. We trade the session line. Now look at June 15th Asia session. June 15th Asia session forms at April 2nd US session upper boundary. It compresses by about 50%. It overlaps there. That matters. The session forms at the boundary of old US memory. Price is not moving through empty space. It is working inside stacked memory. Compression makes the decision tighter. Distance becomes shorter. Reaction can come sooner. Continuation can fail earlier. But when the line holds, the move can become clean. June 15th Asia session forms at that compressed location. Then price falls. It tests April 2nd US session lower boundary. That test matters. Price reaches lower memory. It reacts. It cannot keep falling. Then price rises. It tests June 15th US session upper boundary. The path is clear. Location: April 2nd US upper memory. Reach: April 2nd US lower boundary. Reaction: lower memory holds. Failure: downside continuation fails. Return: price moves back toward June 15th US memory. Now we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders begin with entry. They see the bounce. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve execution. So the long starts with risk. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination above 1.5 risk-reward. If that combination does not appear, skip. For June 15th Asia session, the long setup appears. Long entry line. April 2nd US session lower boundary. Stop-loss line. June 14th Asia session midpoint. Take profit line. June 15th US session midpoint. Risk-reward ratio 1.7. The entry sits at April 2nd US session lower boundary. Why there? Because price has to prove whether old, lower US memory still holds. If price reaches April 2nd US lower boundary and breaks below it, the long has no base. If price reaches that boundary and reacts upward, the trade can form. The entry is not the green candle. The entry is the hold at old lower memory. Price reaches the boundary. It reacts. It cannot stay below. Distance begins to open upward. Then the long becomes active. The stop sits at June 14th Asia session midpoint. Why there? Because the trade depends on the lower memory holding, and the prior compressed Asia structure staying protected. If price loses that midpoint, the bounce has fallen too deeply. The market is no longer defending the structure that supported the move. The long loses control. So the stop belongs at the line where the trade idea breaks, not where the trader feels comfortable, not where the candle looks clean, where the structure fails. If price reaches it, leave. No hope, no argument, no waiting for another candle. The target sits at June 15th U.S. session midpoint. Why there? Because after April 2nd U.S. lower memory holds, price returns toward the next active U.S. memory. The June 15th U.S. midpoint is the first meaningful target inside that return. It is not the highest possible line. It is the clean line where price can react. That keeps the trade realistic. The move does not need to become a full breakout. It only needs to move from lower memory to the active midpoint. Risk-reward ratio is 1.7. That is above the 1.5 filter. But it is not large enough for careless execution. If entry is late after price already leaves April 2nd U.S. lower boundary, the ratio weakens. If the stop is widened below June 14th Asia midpoint, the ratio weakens. If the target is pushed higher before price earns distance, the trade becomes hope. The long only works when the lower memory holds. Now watch the behavior. Price reaches April 2nd U.S. lower boundary. It stops falling. Reaction turns upward. The distance starts to grow. But the move still has friction. Pullbacks can deepen. Bodies can stall. Reaction can speed up. The market is still inside higher time frame pressure. So the trader must manage the position. If price reaches June 15th U.S. midpoint and stalls, protect. If price holds above that midpoint and builds distance, a new structure can form later. But the first trade must respect the first target. The target is not where hope begins. The target is where profit must be protected. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays fast. But near compressed memory, wicks can remove tight stops. Price can dip. The stop can get touched. Then price can still reach the target. The idea was right. The position is gone. That pain must be accepted. A conservative trader gives the structure more room. The stop respects the midpoint. Position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must also expand. A wide stop with the same close target can damage the ratio. So every change must be checked again. Stop. Entry. Target. Risk-reward. All four move together. Now management. If price reaches the target and reaction speeds up, protect more. If price moves cleanly and pullback stays shallow, let the remaining position work. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last green candle. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from the line. The edge comes from April 2nd U.S. lower boundary holding. The edge comes from a target that still pays. June 15th, Asia gives the first message. The session forms at April 2nd U.S. upper memory. Price drops to April 2nd U.S. lower memory. It holds. Then the long moves toward June 15th U.S. midpoint. The trade begins only after lower memory survives. Price goes quiet near the box, but no clean trade appears. The session forms inside old U.S. memory. Before reading June 16th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th kilo. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already tested lower memory and bounced. But a bounce does not erase the field. A session can overlap old memory and still give no execution. A candle can move and still not pay. A line can look important and still produce a bad ratio. That is why the filter stays strict. Now look at June 16th U.S. session. June 16th U.S. session forms inside April 2nd U.S. session box. It overlaps that memory. The session forms inside an older U.S. structure rather than outside it. That matters. Price is not creating clean new territory. It is rotating inside an old field. When a session forms inside an old box, the movement can look active but still stay trapped. Distance becomes limited. Reaction comes faster. Continuation fails earlier. The market can move from line to line without giving a clean trade. After June 16th U.S. session forms, price continues around the lower side of that session box. The flow stays centered near June 16th U.S. lower boundary. It does not open clean distance. It does not give a wide target. It does not give a clean stop. The chart keeps moving. But the account needs more than movement. It needs executable distance. Now we apply the same process. Stop line first. Entry line second. Target line third. Remove overlapping duplicate lines. Use the latest clean lines when possible. Then check whether risk-reward reaches at least 1.5. If no clean combination appears, skip. For June 16th U.S. session, the working lines are visible. June 16th U.S. session upper boundary. June 16th U.S. session midpoint. June 16th U.S. session lower boundary. June 14th Asia session upper boundary. June 14th Asia session midpoint. June 14th Asia session lower boundary. Weekly 0.33. These lines matter, but they are too close. That is the problem. A trader can see many possible entries. A trader can see possible stops. A trader can see possible targets. But when the lines are too close, the combinations do not pay. The long idea appears first. A long can try to use June 16th U.S. lower boundary as entry. The stop could sit below the nearby lower memory. The target could sit at the midpoint or upper boundary. But the space is not clean. If the stop is placed safely, the target does not pay enough. If the stop is tightened to improve the ratio, normal reaction can touch it. If entry is late, the ratio breaks immediately. The long does not give clean execution. Now check the short idea. A short can try to use June 16th U.S. upper boundary or midpoint as entry. The stop could sit above the active box. The target could sit at the lower boundary or weekly 0.33 area. But the same problem appears. The lines are packed. The target is close. The stop becomes too deep. The ratio struggles. If the stop is tightened, the trade becomes fragile. If the stop is widened, the target no longer pays. The short also stays weak. That is why the correct answer can be no trade. Not because nothing happens. Something happens. Price rotates around the lower boundary. It tests. It reacts. It tries to move. But the movement does not become a clean trade. That is the difference. Movement is what price does. Execution is where the account can survive. Many traders confuse the two. They see price moving. They feel they must act. They force a long in the middle. Or they force a short after the first red candle. Then the stop is too close. Or the target is too close. Or the entry is too late. The account pays for bad structure. Here, the filter blocks that mistake. No clean 1.5 risk-reward. No trade. That is not hesitation. That is execution. Now think about why the no trade matters after the previous session. June 15th, Asia gave a long from April 2nd U.S. lower boundary. Risk-reward ratio. 1.7. The line held. The target paid. June 16th, U.S. gives lines, but the combinations are not clean. The environment is different. It forms inside April 2nd U.S. memory. It rotates around June 16th U.S. lower boundary. The distance is smaller. The reaction comes sooner. Continuation fails earlier. So the trader must change behavior. You cannot force yesterday's trade into today's structure. Every session must pass the filter again. Stop. Entry. Target. Risk-reward. If one part fails, the trade stays closed. Now trader type matters again. An aggressive trader may try to make the trade work. The aggressive trader tightens the stop. The risk becomes smaller. The ratio looks better. But inside overlapping memory, tight stops get hit often. A small wick can remove the position. Then price can move in the expected direction. The trader reads the direction correctly. The position disappears. A conservative trader may widen the stop. The trade survives more noise. But now the target must move farther. If the farther target is not realistic, the trade is not conservative. It is just bad math. A wide stop with a close target damages the account slowly. So both styles can reach the same answer. No clean trade. No position. Wait. Now management for no trade. Do not sit there trying to make a candle fit the plan. The plan already answered. If the lines do not pay, the account waits. If price later breaks cleanly above June 16th U.S. upper boundary and holds, a future long can form from a new session line. If price fails below weekly 0.33 and cannot reclaim, a future short can form. But until that happens, the current session stays crowded. The trader does nothing. That is still a decision. That is still discipline. That is still part of the method. The same method that opens trades must reject trades. It opened the long when April 2nd U.S. lower boundary held. It skipped when June 16th U.S. overlap did not pay. That is how the account survives. Now connect back to higher time frame. The weekly chart still controls the environment. Weekly 0.33 remains nearby. The April, March, and February weekly basis levels still shape the field. The falling trendline still limits upside. The rising trendline still gives lower reaction zones. The 1-hour chart is only the execution layer. It cannot be read alone. If today's chart feels confusing, return to monthly, weekly, and daily. Especially weekly. The higher time frame shows why price can move inside old memory without giving clean continuation. The 1-hour chart shows where the line holds or fails. The trade only happens when those layers align. June 16th U.S. gives the second message. The session forms inside April 2nd U.S. memory. Price rotates around the lower boundary. The lines are visible, but the reward does not pay enough. Long setup, not clean. Short setup, not clean. Risk-reward above 1.5, not clean. So the account waits. Price reaches. It reacts. It holds or fails. But if the risk does not deserve the reward, no trade. Price rises first. But it cannot stay above the middle. The session forms below compressed US memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st, weekly basis box lower boundary. March 1st, weekly basis box lower boundary. February 1st, weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, 1-hour movement can look strong and still fail. A bounce can test the middle and still collapse. A short can look late and still pay if the target has space. A long can look tempting and still fail if price cannot stay above the session line. That is why the session line matters. Now look at June 16th Asia session. June 16th Asia session forms below June 16th US session lower boundary. It compresses by about 30%. It overlaps under that US memory. That matters. A session forming below another session lower boundary does not show clean recovery. It shows pressure. It shows that price is still trying to work under the previous US box. The compression makes the decision tighter. Distance becomes shorter. Reaction can come sooner. Continuation can fail earlier. But when the upper side fails, the short can move fast. June 16th Asia session forms under that compressed pressure. Then price rises. It tests June 16th US session midpoint. That test matters. Price reaches the middle of the prior US box. It tries to recover. It cannot stay. Then price drops. It tests weekly 0.33. The flow is clear. Location. Below June 16th US lower boundary. Reach. June 16th US midpoint. Reaction. Recovery fails. Return. Price moves down toward weekly 0.33. Now we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see the first drop. They want to sell. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve execution. So the short starts with risk. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination above 1.5 risk-reward. If the combination is not clean, skip. For June 16th Asia session, the short setup appears. Short entry line. June 16th Asia session upper boundary. Stop-loss line. June 16th US session midpoint. First take profit line. June 14th Asia session midpoint. Trailing take profit line. Weekly 0.33. Risk-reward ratio 2.91. The entry sits at June 16th Asia session upper boundary. Why there? Because the session forms below the prior US lower boundary. The Asia upper boundary becomes the recovery test. If price reclaims that upper boundary and stays above it, the short loses pressure. If price reaches that upper boundary and cannot stay, buyers fail. That failure gives the short. The short is not selling the low. The short is selling failed recovery. Price reaches the Asia upper side. It reacts. It cannot hold. Distance does not open upward. Continuation fails earlier. Reaction comes back faster. Then the short becomes active. The stop sits at June 16th US session midpoint. Why there? Because that midpoint is the recovery line inside the prior US box. If price climbs into that area and holds, the short idea changes. The market is no longer failing under the Asia upper boundary. It is reclaiming deeper US memory. The short loses control, so the stop belongs there. Not too close to the last candle, not placed from fear, placed where the trade loses its reason. If price reaches it, leave. No hope, no argument, no waiting for one more candle. The first target sits at June 14th Asia session midpoint. Why there? Because price is returning into older compressed Asia memory. After the June 16th Asia upper side fails, the first clean destination is the next lower working midpoint. That is where reaction can appear. That is where sellers must prove they can continue. So the first target belongs there. But the move does not have to stop there. If price breaks through that midpoint and keeps holding lower, the target can trail toward weekly 0.33. Weekly 0.33 matters. It is higher time frame memory. It is not an ordinary 1-hour line. When price reaches that area, reaction can speed up. Shorts can cover. Buyers can appear. So the trailing target must be earned. The trade first needs distance. It needs the first target to break. It needs pullbacks to stay weak. It needs price to keep returning lower. Then weekly 0.33 becomes the trailing target. Risk-reward ratio reaches 2.91. That is why the setup deserves attention. The short has a clear entry, a structural stop, a first target, a higher time frame trailing target. But the trade still needs clean execution. If entry is late after price already leaves June 16th Asia upper boundary, the ratio weakens. If the stop is widened above June 16th US midpoint, the ratio weakens. If the trailing target is used before the first target is earned, the trade becomes hope. The short must be taken at the failure line. Not after the easy distance is gone. Now watch the behavior. Price rises to the June 16th US midpoint. It cannot stay. The move stalls. Bodies stop expanding. Pullbacks deepen. Reaction speeds up. Then price returns lower. It reaches toward June 14th Asia midpoint. If price stalls there, protect. If price breaks it and keeps distance, trail toward weekly 0.33. That is the management. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last red candle. Now trader type matters. An aggressive trader may tighten the stop below the June 16th US midpoint. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays fast. But compressed session boxes can whip. A wick can touch the tight stop. Then price can still fall toward weekly 0.33. The idea was right. The position is gone. That pain must be accepted. A conservative trader respects the June 16th US midpoint. The position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must also move farther. A wide stop with a close target damages the ratio. So every change must be checked again. Stop, entry, target, risk-reward. All four move together. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. If the move reaches multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from the line. The edge comes from recovery failure. The edge comes from the target having space. June 16th Asia gives the first message. The session forms below June 16th U.S. lower boundary. Price tests the U.S. midpoint. It cannot stay. Then it falls toward weekly 0.33. The short earns execution only after recovery fails. Price explodes from the lower side. But the same move later turns into a short. The session forms near weekly 0.33. Before reading June 17th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already tested weekly 0.33. That area can create reaction. It can also trap traders. If price holds there, a long can move hard. If price fails after the reaction, the short can return even harder. That is why we do not marry direction. We follow the line. Now look at June 17th U.S. session. June 17th U.S. session forms near weekly 0.33. It overlaps with June 14th Asia session box. That matters. The session forms at a higher timeframe decision area. It is also inside older Asia memory. The market is not moving in empty space. It is reacting from stacked memory. Weekly 0.33 gives the larger pressure. June 14th Asia gives the session memory. June 17th U.S. gives the execution box. After the session forms, price rises. It tests June 16th U.S. session upper boundary. Then, price falls. It tests June 8th U.S. session upper boundary. The move gives two trades. A long first. Then, a short after upper failure. But both trades must pass the same filter. Stop line first. Entry line second. Target line third. Risk-reward above 1.5. If the combination is not clean, skip. Now build the first trade. June 17th U.S. long setup. Entry line. June 17th U.S. session lower boundary. Stop loss line. June 17th U.S. session lower boundary, negative 150% area. First take profit line. June 17th U.S. session upper boundary. First trailing target. June 16th U.S. session lower boundary. Second trailing target. June 16th U.S. session upper boundary. Risk-reward ratio 5.73. The entry sits at June 17th U.S. session lower boundary. Why there? Because the session forms near weekly 0.33 and overlaps June 14th Asia memory. The lower boundary becomes the line where buyers must defend the reaction. If price loses that lower boundary and holds below it, the long has no base. If price reaches it, reacts, and holds above it, the long can open. The entry is not a random bottom pick. The entry is the hold at the active U.S. lower boundary. Price reaches. It reacts. It cannot stay below. Distance opens upward. Then the long becomes active. The stop sits at June 17th U.S. session, lower boundary negative 150% area. That stop is under the active session. It gives the long enough room to survive normal lower testing. But it still defines the failure. If price breaks that extension and holds below it, the reaction from weekly 0.33 has failed. The long no longer has clean control. So the stop belongs there. It is not too tight. It is not unlimited. It is placed where the trade loses its reason. The first target sits at June 17th U.S. session upper boundary. Why there? Because the long starts from the lower side of the same U.S. session box. The first clean objective is the upper side. That is the first place where price can stall. That is where profit must be protected. But this move creates more distance. Price does not only reach the upper boundary, it moves into higher old memory. Then the first trailing target becomes June 16th U.S. session lower boundary. After that, the second trailing target becomes June 16th U.S. session upper boundary. That is how the trade expands. Lower boundary hold. Session upper boundary target. Then trail into prior U.S. memory. Risk-reward ratio reaches 5.73. That is strong. But only because the entry begins at the lower boundary and the stop is defined. If the trader enters late after the move already launches, the ratio collapses. If the stop is moved wider without reason, the ratio weakens. If the trader refuses to protect profit at the first target, the move can give back too much. So the large number does not remove discipline. It demands discipline. Now management becomes critical. When price reaches June 17th U.S. upper boundary, protect. If price stalls there, take the first result. If price breaks through and holds, the first trail can open toward June 16th U.S. lower boundary. If price keeps holding and distance stays strong, the second trail can open toward June 16th U.S. upper boundary. But every target move needs a stop move. A target that moves without a stop is only hope. The trail must not be too tight. Normal reaction can hit it. The trail must not be too loose. Profit can disappear. A practical trailing interval needs about 0.5 risk-reward unit or more. Now the second trade appears. After price reaches higher memory, it later fails. June 16th U.S. session upper boundary becomes the short entry area. Additional short setup. Short entry line. June 16th U.S. session upper boundary. Stop-loss line. June 15th U.S. session midpoint. First take profit line. June 16th U.S. session lower boundary. First trailing target. June 17th U.S. session upper boundary. Second trailing target. June 17th U.S. session lower boundary. Third trailing target. June 17th U.S. session lower boundary, negative 200% area. Risk-reward ratio, 7.47. The entry sits at June 16th U.S. session upper boundary. Why there? Because price has reached upper prior U.S. memory. If price holds above it, the short has no reason. If price reaches that upper boundary and cannot stay, buyers fail. The long move has already earned distance. Now continuation begins to fail. Reaction speeds up. Distance becomes shorter. Then the short can form. The stop sits at June 15th U.S. session midpoint. That stop protects the real upper failure. If price recovers above the failed upper zone and moves back into that prior midpoint memory, the short loses control. The market is not rejecting upper memory anymore. It is reclaiming it. So the stop belongs there. The first target sits at June 16th U.S. session lower boundary. Why there? Because the short is a rotation back through the same June 16th U.S. box. If the upper side fails, the lower side becomes the first clean destination. That first target protects the trade. Then the trail can extend. First toward June 17th U.S. upper boundary. Then toward June 17th U.S. lower boundary. Then toward June 17th U.S. lower boundary, negative 200% area. That is a strong trail. But it must be earned. The short must first break through the first target. Then it must keep holding lower. Then pullbacks must fail earlier. Then distance must keep opening. Only then does the deeper trailing target become valid. Risk-reward ratio reaches 7.47. That is the strongest structure in this sequence. But again, the number depends on execution. Entry near the upper failure. Stop at the real reclaim line. Target sequence that follows memory. If entry is late, the trade becomes weaker. If the stop is widened, the ratio weakens. If the trader holds without moving the stop, the profit is exposed. Now compare both trades. The long starts at June 17th U.S. lower boundary. It trails toward June 16th U.S. upper memory. Risk-reward ratio 5.73. The short starts after June 16th U.S. upper memory fails. It trails back through June 16th and June 17th memory. Risk-reward ratio 7.47. This is not contradiction. This is session rotation. The long works first because weekly 0.33 holds. The short works later because upper memory fails. A trader who marries the long misses the short. A trader who marries the short misses the long. A trader who watches the line can take both. Now, trader type matters again. An aggressive trader may take tighter stops and larger size. That can pay fast in a move like this. But the risk is sharp. A wick can remove the position before the real move begins. A conservative trader gives the structure more room. Size becomes smaller. The trade survives more noise. But the target must still pay. Here, both structures pay. So management becomes more important than prediction. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create edge. The edge comes from the boundary. The edge comes from holding. The edge comes from failure. June 17th U.S. gives the final message. Weekly 0.33 holds first. The long launches. Upper memory fails later. The short returns. Price reaches. It reacts. It holds or fails. Then the trade begins. Price pushes into the upper side. But the move cannot stay free. The session forms at old upper memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th kilo. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour candle can look strong and still fail. A pullback can look weak and still become the next long. A breakout can reach old resistance and still return to the box. That is why we do not trade the candle alone. We trade the session line. Now look at June 17th Asia session. June 17th Asia session forms at June 8th U.S. session upper boundary. It overlaps there. The session forms at the boundary of old U.S. memory. That matters. Price is not moving through empty space. It is moving inside a stacked area. Old U.S. memory sits under it. New Asia memory forms around it. The higher time frame still holds pressure above and below. So the first job is not to predict direction. The first job is to find the working box. June 17th Asia session forms at that old upper memory. Then, price moves higher. It tests June 17th U.S. session upper boundary. The move looks strong. Buyers push up. Distance opens. But the move does not keep clean continuation. Then price turns lower. It falls back into June 17th Asia session box. It tests June 17th Asia session lower boundary. The path is clear. Location: June 8th, U.S. upper memory. Reach: June 17th U.S. upper boundary. Reaction: continuation slows. Failure: price cannot stay higher. Return: price comes back to June 17th Asia lower boundary. Now the trade is not at the high. The trade is at the lower boundary after the return. That is where many traders get confused. They see price fall from the high. They think short only. But the session box gives a different question. Can the lower boundary hold? If it holds, the long can form. If it breaks, no long. So we build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders begin with entry. They see price touching a level. They want to act. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the trade does not deserve execution. So the long starts with risk. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination above 1.5 risk-reward. If that combination does not appear, skip. For June 17th Asia session, the long setup appears. Long entry line. June 17th Asia session lower boundary. Stop loss line. June 12th U.S. session upper boundary. Take profit line. June 17th Asia session upper boundary. Risk-reward ratio: 1.69. The entry sits at June 17th Asia session lower boundary. Why there? Because price has already reached the upper side and returned. The long is not chasing strength. The long waits for the lower side of the active Asia box. If price reaches June 17th Asia lower boundary and breaks down, the long has no base. If price reaches that lower boundary and reacts upward, buyers defend the session. That hold creates the long. The entry is the defended line. Not the green candle. Not the feeling that price is cheap. Price reaches the lower boundary. It reacts. It cannot continue lower. Distance starts to open upward again. Then the long becomes active. The stop sits at June 12th U.S. session upper boundary. That line may look old, but it still sits inside the lower memory that protects the trade. If price loses that area, the move has fallen out of the working Asia structure and returned too deeply into prior U.S. memory. The long is no longer clean. The bounce has lost its base. So that line becomes the failure line. Not a random loss limit. Not a fear line. The line where the trade loses its reason. If price reaches it, leave. No hope. No argument. No waiting for one more candle. The target sits at June 17th Asia session upper boundary. Why there? Because the trade starts from the lower side of the same Asia session box. The first clean objective is the upper side. That is where reaction can appear. That is where buyers must prove they can push beyond the range. So the target is not unlimited upside. It is the opposite side of the active box. That keeps the trade realistic. Risk-reward ratio is 1.69. It clears the 1.5 filter. But it is not large enough for sloppy execution. If entry is late after price already moves away from the lower boundary, the ratio weakens. If the stop is widened below June 12th U.S. upper memory, the ratio weakens. If the target is pushed above the Asia upper boundary before price earns distance, the trade becomes hope. This long needs precision. Now watch the behavior. Price falls into June 17th Asia lower boundary. The move stalls. Selling cannot continue. Reaction turns upward. Distance begins to grow. But the market still moves inside old memory. Pullbacks can deepen. Reaction can come back quickly. continuation can fail at the upper boundary. So the trader must protect the result when price reaches the target. If price reaches June 17th Asia upper boundary and stalls, take the result. If price breaks above it and holds, a new structure can form later. But until that hold appears, the target is the target. Do not turn a range long into a breakout prediction. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays faster. But inside overlapping memory, wicks can remove tight stops. Price can dip. The stop can get touched. Then price can still move to target. The idea was right. The position is gone. That pain must be accepted. A conservative trader gives the structure more room. The stop respects deeper memory. Position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must also expand. A wide stop with the same close target can destroy the ratio. So every line must be checked together. Stop, entry, target, risk-reward. All four move together. June 17th Asia gives the first message. The session forms at June 8th U.S. upper memory. Price pushes to June 17th U.S. upper boundary. It cannot stay free. It returns to June 17th Asia lower boundary. The long opens only if that lower boundary holds. Price reaches. It reacts. It holds. Then the trade begins. Price breaks lower. But the trade starts before the low. The session forms inside the same Asia memory. Before reading June 18th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already rotated through old memory. A long can work from a lower boundary. Then the next session can still fail lower. That is why direction cannot become identity. You do not marry the long. You do not marry the short. You follow the line. Now look at June 18th U.S. session. June 18th U.S. session forms almost completely overlapping with June 17th Asia session box. The session forms inside the same working memory. That matters. A new U.S. session does not create clean, new space. It sits on top of the prior Asia structure. The market is still trading inside the same battlefield. When sessions overlap this tightly, the next move can be sharp. But the trade still needs structure. Overlap alone is not entry. Price must reach. Price must fail. Price must return. After June 18th U.S. session forms, price moves lower. It breaks below June 12th U.S. session lower boundary. That break matters. The market loses a nearby lower memory line. Then price continues lower. It tests the upper boundary area of June 10th U.S. session and June 5th U.S. session. The movement is not random. Location. June 18th U.S. overlaps June 17th Asia. Reach. Lower boundary gets tested. Reaction. Buyers fail to hold. Failure. Price breaks June 12th U.S. lower boundary. Return. Price moves toward older U.S. upper memory below. Now the short setup appears. But again, we do not short just because price is red. We build the trade in the correct order. Stop line first. Entry line second. Target line third. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination above 1.5 risk-reward. If no clean combination appears, skip. For June 18th U.S. session, the short setup appears. Short entry line. June 18th U.S. session lower boundary. Stop loss line. June 18th U.S. session upper boundary. Take profit line. June 11th U.S. session lower boundary. Risk-reward ratio 1.64. The entry sits at June 18th U.S. session lower boundary. Why there? Because the U.S. session overlaps the prior Asia box. The lower boundary becomes the decision line. If price holds above that lower boundary, the short has no control. If price reaches that lower boundary, breaks below it, and cannot reclaim it, sellers take control. The entry is not the panic candle. The entry is the failed reclaim under the active U.S. lower boundary. Price reaches the lower side. It breaks. It tries to return. It cannot stay above. Distance opens lower. Then the short becomes active. The stop sits at June 18th U.S. session upper boundary. Why there? Because the short depends on the entire June 18th U.S. box failing from the lower side. If price returns through the box and reaches the upper boundary, the failure is no longer clean. The market has reclaimed the active session range. The short loses control. So the stop belongs at the upper boundary, not inside random noise, not too close to the candle, at the line where the trade idea breaks. If price reaches it, leave. No hope, no argument, no waiting for another candle. The target sits at June 11th U.S. session lower boundary. Why there? Because after the June 18th U.S. lower boundary fails, price moves toward older lower U.S. memory. June 11th U.S. lower boundary is the next meaningful destination. It is where reaction can appear. It is where shorts can cover. It is where buyers can test a response. So the target is realistic. It is not chosen because it looks far. It is chosen because the market has a reason to react there. Risk-reward ratio is 1.64. That clears the 1.5 filter. But it is not generous. The trade needs clean execution. If entry comes late after price already breaks down, the ratio weakens. If the stop is widened above June 18th U.S. upper boundary, the ratio weakens. If the target is pushed below June 11th U.S. lower boundary before price earns distance, the trade becomes hope. The short must be taken near the failed lower boundary, not after the easy distance is gone. Now watch the behavior. Price breaks below June 12th U.S. lower boundary. The move accelerates. Reaction tries to return. It cannot reclaim the active lower line. Continuation downward opens. Pullbacks become weaker. Reaction from buyers comes late. Then price tests the June 10th and June 5th U.S. upper boundary area. The trade is still under pressure, but management stays important. If price approaches June 11th U.S. lower boundary and stalls, protect. If price breaks through and holds, a future structure can form. But the first trade must respect the target. The target is not where hope begins. The target is where profit must be protected. Now trader type matters again. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns high enough to touch it. The short pays quickly. But overlapping sessions can whip. A wick can reclaim the lower boundary for a moment. A tight stop can get touched. Then, price can still fall. The idea was right. The position is gone. A conservative trader respects the full session box. The stop sits at the upper boundary. Position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the answer. Here, the ratio is 1.64. It is valid but narrow. That makes entry quality critical. Now think about the contrast with the earlier trade. June 17th Asia gave a long from the lower boundary. Risk-reward ratio, 1.69. June 18th US gives a short from the lower boundary failure. Risk-reward ratio, 1.64. Both trades are close to the minimum filter. Neither trade allows lazy entry. The difference is behavior. June 17th Asia lower boundary holds. Long forms. June 18th US lower boundary fails. Short forms. Same style. Different result. The line decides. Price reaches. It reacts. It holds or fails. Then the trade begins. That is the lesson. A boundary is not automatically support. A boundary is not automatically resistance. It becomes tradable only after behavior appears. If it holds, you can study the long. If it fails, you can study the short. If the risk-reward does not pay, you skip. Now connect back to the higher time frame. The weekly chart still controls the field. Weekly 0.33 and weekly 0.25 stay important below. The February 5th key low still matters. The falling trend line still limits recovery. The rising trend line still creates possible lower reaction. The 1-hour chart gives the entry. But the higher time frame tells us why the move can keep pressing from box to box. If today's chart feels confusing, return to monthly, weekly, and daily. Especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. June 18th US gives the second message. This session forms almost fully overlapping with June 17th Asia. Price breaks below the active lower boundary. It cannot reclaim. The short opens. Entry. June 18th US lower boundary. Stop. June 18th US upper boundary. Target. June 11th US lower boundary. Risk-reward ratio, 1.64. The trade is not a prediction. It is a failed hold. Price reaches. It reacts. It fails. Then the short earns execution. Price rises into resistance, but it cannot stay above it. The session forms inside compressed US memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the session blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour bounce can look strong and still fail. A green candle can reach old resistance and still return lower. A short can look risky at first, but if the upper hold fails, the target can still pay. That is why we do not trade the candle alone. We trade the session line. Now look at June 18th Asia session. June 18th Asia session forms between June 11th US session lower boundary and June 11th US session midpoint. It compresses by about 50%. It overlaps there. The session forms inside a dense memory zone. That matters. Price is not moving through empty space. It is moving between old US lines. June 11th US lower boundary sits below. June 11th US midpoint sits above. The new Asia session forms inside that pressure. When a session forms inside old memory, the movement can feel active but still stay trapped. Distance becomes shorter. Reaction comes sooner. Continuation fails earlier. The box gives pressure. The box gives the trade. After June 18th Asia session forms, price moves higher. It tests June 12th US session lower boundary. That test matters. Price reaches the upper side of nearby old memory. It tries to recover, but it cannot stay there. Then, price turns lower. It tests the upper boundary area of June 10th U.S. session and June 5th U.S. session. The path is clear. Location: June 18th Asia forms between June 11th U.S. lower and midpoint. Reach: price tests June 12th U.S. lower boundary. Reaction: recovery stalls. Failure: price cannot stay above old resistance. Return: price moves down toward June 10th and June 5th U.S. upper memory. Now the short setup appears. But we do not short just because the candle turns red. We build the trade in the correct order. Stop line first. Entry line second. Target line third. Most traders begin with entry. They see rejection. They want to sell. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the trade does not deserve execution. So the short starts with risk. When lines overlap, remove duplicated lines. Use the latest clean line when possible. Then find a combination above 1.5 risk-reward. If that combination does not appear, skip. For June 18th Asia session, the short setup is clean enough. Short entry line: June 12th U.S. session, lower boundary. Stop loss line: June 11th U.S. session, upper boundary. Take profit line: June 10th U.S. session, upper boundary. Risk-reward ratio: 1.72. The entry sits at June 12th U.S. session, lower boundary. Why there? Because price rises into that old U.S. lower boundary and fails to stay. If price reclaims June 12th U.S. lower boundary and holds above it, the short has no reason. If price reaches that line and cannot stay, the recovery fails. That failed recovery gives the short. The entry is not the first red candle. The entry is the failed hold under the old U.S. line. Price reaches. It reacts. It cannot stay. Distance does not open upward. Reaction comes back faster. Then the short becomes active. The stop sits at June 11th U.S. session, upper boundary. Why there? Because the short depends on price failing under June 12th U.S. lower memory. If price climbs back through that area and reaches June 11th U.S. upper boundary, the short pressure has changed. The market is no longer rejecting nearby resistance. It is reclaiming higher old memory. The trade loses control. So the stop belongs at June 11th U.S. upper boundary. Not too close to the candle. Not placed from fear. Placed where the trade loses its reason. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at June 10th U.S. session, upper boundary. Why there? Because after June 12th U.S. lower boundary fails, price moves down toward the next older U.S. upper memory. June 10th U.S. upper boundary is a realistic target. It sits below the failed recovery zone. It gives sellers a clean destination. It also gives enough distance for the trade to pass the filter. Risk-reward ratio is 1.72. That clears the 1.5 minimum. But it is still not a wide-open trade. The entry must be clean. If the trader sells late after price already falls away from June 12th U.S. lower boundary, the ratio weakens. If the stop is widened above June 11th U.S. upper boundary, the ratio weakens. If the target is pushed below June 10th U.S. upper boundary before price earns distance, the trade becomes hope. The short must be taken near the failed line, not after the easy distance is gone. Now watch the behavior. Price rises to June 12th U.S. lower boundary. It cannot stay. The move stalls. Pullbacks deepen. Reaction comes down faster. Then price returns toward June 10th and June 5th U.S. upper memory. The trade works because recovery fails. Not because sellers are always right. Not because the market must fall. Because price reaches the line and cannot hold. That difference matters. A boundary is not automatically short. A boundary becomes short only after failed holding. If price had reclaimed and stayed above June 12th U.S. lower boundary, no short. If price had moved too close to the target before entry, no short. If the stop, entry, and target did not give 1.5 or more, no short. The filter decides. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays quickly. But inside overlapping session memory, wicks can remove tight stops. Price can push upward, touch the tight stop, then fall toward the target. The idea was right. The position is gone. That pain must be accepted. A conservative trader respects the wider stop at June 11th U.S. upper boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes even wider, the target must also move farther. A wide stop with the same close target damages the ratio. So every change must be checked again. Stop, entry, target, risk-reward. All four move together. Now management. If price reaches June 10th U.S. upper boundary and stalls, protect. Do not assume the breakdown continues. June 10th U.S. upper memory can react. June 5th U.S. upper memory can react too. Sellers can cover. Buyers can test a response. So the target must be respected. If price breaks the target and holds lower, a future structure can form. But until that hold appears, the first job is to take the planned trade. The method is not about catching every candle. It is about taking the line that pays. June 18th Asia gives the first message. The session forms between June 11th U.S. lower and midpoint. Price rises to June 12th U.S. lower boundary. It cannot stay. The short opens from failed recovery. Entry. June 12th U.S. lower boundary. Stop. June 11th U.S. upper boundary. Target. June 10th U.S. upper boundary. Risk-reward ratio. 1.72. Price reaches. It reacts. It fails. Then the trade begins. Price stays inside the box. But the trade does not open. The session forms inside overlapping U.S. memory. Before reading June 19th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has already moved through several old U.S. boxes. Some sessions gave clean trades. Some sessions only gave movement. That difference matters. A candle can move. A level can react. A session can overlap. Still, the trade can be rejected. Now look at June 19th U.S. session. June 19th U.S. session forms overlapping with June 11th U.S. session box and June 12th U.S. session box. The session forms inside the same crowded memory area. That matters. Price is not creating clean new space. It is not expanding away from the old structure. It is moving inside stacked U.S. memory. June 11th memory is there. June 12th memory is there. June 19th forms inside them. The field is crowded. When sessions overlap like this, the chart can still move. But the execution can get worse. Distance becomes shorter. Reaction comes sooner. Continuation fails earlier. The target gets closer. The stop gets harder. That is where traders force bad trades. After June 19th U.S. session forms, price continues inside the June 19th U.S. session box. It does not break cleanly away. It does not open clear distance. It moves within the box. That movement can tempt both sides. Long traders see lower reactions. Short traders see upper failures. But temptation is not execution. The trade still needs 3 lines: stop line, entry line, target line, and the combination must give more than 1.5 risk-reward. Now list the working lines. June 19th U.S. session upper boundary. June 19th U.S. session midpoint. June 19th U.S. session lower boundary. June 10th U.S. session upper boundary. June 10th U.S. session midpoint. June 10th U.S. session lower boundary. June 18th U.S. session upper boundary. June 18th U.S. session midpoint. June 18th U.S. session lower boundary. These lines are visible. They matter. But many of them sit too close. That is the problem. A trader can see possible entries. A trader can see possible stops. A trader can see possible targets. But when the lines are too close, the trade does not pay. The chart gives structure, but the ratio refuses execution. Now check the long idea. A long could try to use the June 19th U.S. lower boundary as entry. The stop could sit below the next lower memory. The target could sit at the June 19th U.S. midpoint or upper boundary, but the space is not clean. If the stop is placed safely, the target does not pay enough. If the stop is tightened to improve the ratio, normal reaction can touch it. If the entry is late, the ratio breaks immediately. The long does not give a clean 1.5 combination. Now check the short idea. A short could try to use June 19th U.S. upper boundary or midpoint as entry. The stop could sit above the active box or above nearby old memory. The target could sit at the June 19th U.S. lower boundary or the June 18th U.S. memory below. But the same problem appears. The target is close. The stop becomes too wide. The ratio struggles. If the stop is tightened, the trade becomes fragile. If the stop is widened, the target does not pay. The short also does not give a clean 1.5 combination. That is why the correct answer can be no trade. Not because nothing happens. Something happens. Price moves inside the box. It tests lines. It reacts. It gives candles. But the account needs more than candles. The account needs executable distance. Movement is what price does. Execution is where the trader survives. Those are different. Many traders lose money in sessions like this. They see the market moving. They feel they must act. They take a long because price bounced from the lower side. Then the target is too close. They take a short because price fails near the upper side. Then the stop is too wide. They enter late because they want confirmation. Then the ratio disappears. The account pays for a trade that should never have opened. Here, the filter protects the account. No clean 1.5 risk-reward. No trade. Now the weekly timing matters too. June 19th U.S. session is the final U.S. session of the week. That matters. The final session can become tricky. Traders can close positions. Liquidity can change. Follow-through can weaken. Wicks can get sharper. A position held into the weekend can create unnecessary pressure. If the setup is excellent, take it. If the setup is unclear, skip. Here, the setup is not excellent. The lines are crowded. The risk-reward does not stay clean. The market stays inside the box. So no trade becomes the better strategy. That is not fear. That is execution. A clean method must do 2 things. It must enter when the line pays. It must refuse when the line does not pay. If the method only enters, the account gets tired. If the method can also skip, the account survives. Now compare with the previous session. June 18th, Asia gave a short. Entry. June 12th, U.S. lower boundary. Stop. June 11th, U.S. upper boundary. Target. June 10th, U.S. upper boundary. Risk-reward ratio. 1.72. The lines gave enough space. The trade could be taken. June 19th, U.S. gives visible lines too, but they do not combine cleanly. The difference is not opinion. The difference is math. Stop. Entry. Target. Risk-reward. The filter says no. So the trader waits. Now trader type matters again. An aggressive trader may try to create a trade by tightening the stop. The stop becomes smaller. The ratio may look better. But in a crowded overlapping box, tight stops get touched often. A small wick can remove the position. Then price can move in the expected direction. The trader read the direction, but the trade was still poorly placed. A conservative trader may use a wider stop. That gives the position more room. But then the target must move farther. If the farther target is not realistic, the wide stop is not conservative. It is bad math. So both styles can reach the same answer. No clean trade. No position. Wait. Now management for no trade. Do not sit there trying to force the chart to answer. The chart already answered. If stop, entry, and target do not align, the account waits. If price breaks cleanly later and forms a new session line, study that new line. If price reclaims the upper side and holds, a future long can form. If price fails below the lower side and cannot reclaim, a future short can form. But inside June 19th U.S. session, the clean setup does not appear. The final session of the week should not be forced. A calm weekend can be part of the strategy. No trade can protect more than a bad trade can earn. Now connect back to higher time frame. The weekly chart still controls the field. Weekly 0.33 and weekly 0.25 remain important. The February 5th key low still matters below. The falling trend line still limits recovery. The rising trend line still gives possible lower reaction. The 1-hour chart gives the entry. But the higher time frame explains why price keeps moving from memory to memory. If today's chart feels confusing, return to monthly, weekly, and daily. Especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. June 19th U.S. gives the final message. The session forms inside June 11th and June 12th U.S. memory. Price stays inside the box. The lines are visible. But the reward does not pay enough. Long idea. Not clean. Short idea. Not clean. Risk-reward above 1.5. Not clean. Final session of the week. No trade. Price reaches. It reacts. It holds or fails. But if the risk does not deserve the reward, the account waits. The 1-hour chart moved fast. But the larger chart carried the reason. The week now returns to higher time frame memory. The 1-hour chart gave execution. The daily chart gives the path. The weekly chart gives the pressure. The monthly chart gives the larger risk. That order matters. A 1-hour candle can look like a breakout. But the daily chart can show old resistance above. A 1-hour drop can look like a breakdown. But the weekly chart can show 0.33 or 0.25 sitting directly below. A 1-hour bounce can look like reversal. But the monthly chart can still show a failed reclaim from May. So we step back. Not to predict. To locate. This week the daily chart moved through major memory. June began inside the empty space between February and March daily structures. Then price broke April. Then price broke March. Then price tested the February 5th key low. After that, price reclaimed weekly 0.33. But it could not keep clean control. It returned lower and tested the rising trendline area again. That is why the 1-hour chart kept flipping. Long. Short. No trade. The weekly chart explains the pressure. June 1st weekly basis box expanded inside old February memory. The weekly movement now sits near June lower memory, weekly 0.33 and the third rising trend line. That is not a free area. That is a decision area. A trader cannot enter blindly there. The monthly chart explains why the reaction can be violent. June monthly candle is testing the February low. It still carries the weight of May failing at the 2026 monthly lower boundary. That failure has not disappeared. So next week cannot be simple. Not long only. Not short only. Not bounce, because price is low. Not short because price is weak. The plan must stay conditional. If price reclaims weekly 0.33 and holds above it, the long can be studied on the 1-hour chart. If price fails weekly 0.33 and returns lower, the short can be studied toward weekly 0.25. If price reaches 0.25 and reacts, the trader must check whether the reaction gives clean risk-reward. If it does not, no trade. That is the execution bridge. Higher time frame gives location. Session memory gives the trigger. Risk-reward decides survival. Do not use the daily, weekly, and monthly charts to predict a perfect move. Use them to know where the next 1-hour trade can fail. Use them to know why a strong candle may not be enough. Use them to know why a famous level is not automatically entry. A level must hold or fail. Then the trade can form. Price reaches. It reacts. It holds or fails. Then the trader acts. Price breaks down first, but the bounce still cannot win cleanly. The daily chart forms inside lower memory. Look at the daily chart. June 1st daily basis box forms exactly in the empty space between the February 1st daily basis box lower boundary and the March 1st daily basis box. That location matters. It does not form safely above February memory. It does not form deeply inside March balance. It forms between old structures. When price forms inside empty space, the next move can travel quickly. There is less support inside the gap. There is less resistance inside the gap. Price must find the next real boundary. That is why the 1-hour chart moved aggressively this week. The daily chart was not giving calm balance. It was giving open travel between old memory lines. Then price fell. It broke below the April 1st daily basis box lower boundary. April memory failed. Price reached it. It reacted. It could not recover. Then price moved lower again. It broke below the March 1st daily basis box lower boundary. That same area connects with weekly 0.33. So the daily chart lost another major line. April lower boundary failed. March lower boundary failed. Weekly 0.33 failed. Then price dropped into the February 5th key low. That point matters. It sits near the rising trendline area. It also sits near weekly 0.25. Buyers want reaction there. Shorts want continuation there. Both sides feel pressure. But the level alone does not create a trade. Price must hold or fail with structure. After testing the February 5th key low, price bounced. It reclaimed weekly 0.33. That bounce created 1-hour-long opportunities. But the daily chart still had resistance above. Price pushed toward the April 1st daily basis box lower boundary. It tested that area. Then it failed to keep control. The move returned lower. Price broke back below the March 1st daily basis box lower boundary. It returned below weekly 0.33. Then price started testing the third rising trendline area. That is the daily sequence. Break April. Break March. Test February 5th key low. reclaim 0.33. Test April lower memory. Fail again. Lose 0.33 again. Test the rising trendline. That explains the 1-hour chart. When 1-hour longs worked, they worked because lower memory held. When 1-hour shorts worked, they worked because recovery failed near old memory. When no trade appeared, it was because the daily chart was inside crowded levels, and the 1-hour target could not pay enough. Now the next daily strategy. If price holds the third rising trend line and reclaims weekly 0.33 again, a long can be studied. But do not buy the first green candle. Wait for reclaim. Wait for hold. Wait for a session boundary. The long needs a stop below the defended structure. The target must reach the next daily memory. If the target is too close, no trade. If price fails under weekly 0.33 and cannot reclaim, short pressure stays active. The next downside focus stays toward weekly 0.25 and the February 5th key low area. But do not chase after distance is gone. Wait for failed reclaim. Wait for a session line. Wait for risk-reward. If price stays between weekly 0.33 and weekly 0.25, 1-hour trades must stay defensive. Targets must be respected. Trailing must protect faster. No trade must remain available. The daily chart gives the warning. Price is not in clean trend freedom. Price is moving between heavy memory lines. A bounce can work, then fail. A drop can work, then react. The trader must not marry direction. The trader must trade the boundary. Price reaches. It reacts. It holds or fails. Then the trade begins. Price sits near the weekly decision line. But the larger trap began earlier. The weekly chart shows why this week mattered. June 1st weekly basis box fully contains the April basis box and the March basis box. It also overlaps inside the February 1st weekly basis box. That matters. June does not form in clean new territory. June expands inside old February memory. That expansion came after months of compression. March 1st weekly basis box formed compressed inside February. April 1st weekly basis box formed compressed inside March. May 1st weekly basis box formed compressed near February upper memory. From March forward, the market kept compressing. Moves became shorter. Reactions came sooner. Continuation failed earlier. Then June expanded inside February memory. Compression built pressure. June gave range. That is why the 1-hour chart produced sharp movement. The weekly structure allowed price to move from one side of old memory toward the other. After that, price moved near the lower side of the June weekly basis box. It stayed near weekly 0.33. It stayed near the third rising trend line. That area now matters for next week. If price holds there, the long can form later. If price fails there, lower rotation remains active. Now look at the trend lines. From February, price moved between the first falling trend line and the second falling trend line. Then it broke upward. But it did not gain clean freedom. Price moved sideways again. Now price is caught between the second falling trend line and the third falling trend line. The falling trend lines are spaced with similar proportion. The rising trend lines also show similar spacing. That matters. The market keeps building channels of pressure. It breaks one, then gets caught in the next. It reacts from one side, then returns to another side. So next week, the trend lines must stay visible, not as prediction, as location. If price reaches a falling trend line and fails, short pressure can return. If price reaches a rising trend line and holds, reaction can form. If price breaks a trend line and cannot reclaim, continuation can appear. But no trend line gives entry by itself. The session still gives execution. Now connect the boxes. March compressed inside February. April compressed inside March. May compressed near February upper memory. Then June expanded inside February. The weekly chart now moves between weekly 0.25 and weekly 0.33. Last week's scenario focused on that zone. This week, price stayed inside that same fight. Weekly 0.33 did not give clean freedom. Weekly 0.25 still sits below. The February 5th key low stays near the lower decision area. That explains the 1-hour chart. When price bounced from lower memory, weekly support pressure was active. When price failed again near upper memory, weekly resistance and old daily memory pushed back. When the final session did not pay, weekly compression and crowded memory kept distance limited. Now the next weekly strategy. If price reclaims weekly 0.33 and holds above it, a long can form later. But it needs 1-hour confirmation. The session must form above the line. Price must hold the boundary. The stop must sit below real failure. The target must reach the next weekly or daily memory. If price cannot hold above weekly 0.33, do not force the long. If price fails weekly 0.33 and returns lower, short pressure can continue toward weekly 0.25. But the short also needs proof. It needs failed reclaim. It needs distance. It needs risk-reward. If price rotates between 0.33 and 0.25, the best trade may be smaller, or no trade. That is not weakness. That is survival. The weekly chart gives the field. June expansion inside February. Lower movement near 0.33. 0.25 below. Third rising trendline nearby. Falling trendline pressure above. The trader cannot guess inside that. The trader waits. Price reaches. It reacts. It holds or fails. Then the 1-hour trade earns execution. Price tests the old low again. But the monthly chart still holds the larger pressure. June monthly candle is testing the February monthly low. Weekly 0.25 sits below and nearby. That matters. A monthly candle near the February low can create violent reaction. It can also trap early buyers. The candle is still a long bearish candle. The body remains heavy. The lower test is active. So the trader must stay careful. Look back at May. May monthly candle tested the lower boundary of the 2026 monthly basis box. That area connected with the weekly 0.55 zone. May failed there. It could not reclaim. It could not stay. After that failure, June rotated lower. That sequence matters. May failed higher memory. June tested the old low. April formed between 0.33 and 0.5. It did not reclaim upper structure. March left an upper wick. April confirmed the wick. April also overlapped the February drop. Then May failed at the 2026 lower boundary. Now June is testing the February low. That is not random. It is monthly behavior. Drop. Reaction. Failure. Return. The 1-hour chart only shows the execution layer. The monthly chart shows why the drop can keep pressure after a bounce. A trader sees 1-hour bounce. A trader wants the bottom. But the monthly candle still has lower memory. The long can work on the 1-hour chart. But the monthly chart warns against holding hope without proof. Now look at the 2026 first monthly basis box. It overlaps the lower boundary of the 2025 first monthly basis box. That connection matters. Old yearly memory and current yearly memory are stacked. May tested that area and failed. So June is not moving from clean, bullish recovery. June is moving after a failed monthly reclaim. That is why the daily and weekly charts stayed heavy. That is why weekly 0.33 kept pulling price back. That is why 1-hour longs had to be managed quickly. Now, the next monthly strategy. If June holds above the February monthly low and starts reclaiming 0.33, the long can be studied later. But it needs proof. A monthly low alone is not entry. A 1-hour reclaim must appear. A daily hold must follow. A weekly recovery must confirm. If price cannot reclaim 0.33, the bounce can remain only reaction. If price breaks below the February monthly low and cannot reclaim it, short pressure stays active. Then weekly 0.25 becomes critical. If weekly 0.25 fails and price cannot recover, the monthly chart opens deeper risk. But do not chase the breakdown after distance is gone. Wait for failed reclaim. Wait for a session line. Wait for risk-reward. The monthly chart gives the biggest warning. Buyers can enter too early because the February low looks important. Sellers can enter too late because the drop looks strong. Both can fail if the structure does not pay. So the monthly plan must stay conditional. If price holds the February low, watch for reclaim. If price fails the February low, watch for failed reclaim short. If price rotates around the low, protect the account. No trade can be correct. Now connect everything. The daily chart shows June breaking through April and March memory, testing the February 5th key low, reclaiming weekly 0.33, then losing it again. The weekly chart shows June expanding inside February memory and rotating between weekly 0.33 and 0.25. The monthly chart shows June testing the February monthly low after May failed the 2026 monthly lower boundary. That is the full map. Monthly risk. Weekly field. Daily path. 1-hour execution. The trader does not predict the bottom. The trader does not chase the crash. The trader waits. Price reaches. It reacts. It holds or fails. Then the trade can form. If the trade does not form, the account waits.